Good morning. I'm Aninda Kara, Product Director of Global Investor Group, and it's my pleasure to welcome you today to today's Buyside Repo and Regulatory Forum. Today's agenda will consist of 3 panel discussions and a fireside chat. At each session, we will hear from industry leaders from across Europe who will be addressing the most pressing challenges facing the industry today. I'd like to take this opportunity to thank all of our speakers who will be contributing to today's sessions, and thank you to all of our sponsors for their support. Our first session of the day will examine whether buy-side market dynamics help or hinder the use of repo. Moderating this session, I'm delighted to welcome our panel moderator, Bill Foley, founder and director of SecFinHub Limited. Bill's career spans more than 25 years, and he has held senior positions at Warburg, ABN AMRO, Deutsche Bank, JP Morgan and RBC before founding SecFinHub Limited in 2016. To discuss our first panel and our first topic of the day, Bill is joined by panelists including Aviva Investors, Clearstream, Standard Chartered Bank, Connexion Markets and LCHSA. Remember, this day is not only to hear from our speakers, but we'd also like to hear from you. And we encourage you to ask questions throughout each of the sessions, which you can do via the chat function on your screen. Every session will be recorded and will be available on demand after the event. I'd like to now hand over to Bill to get this morning's session started.
Thanks, Aninda. Good morning, everybody, and welcome. So just to continue the introduction today, this particular panel is going to look at buy-side participation today. Do market dynamics help or hinder the use of repo? So we're going to take a look at the current conditions, the size of the market and its composition, the routes to market available, and the benefits offered, challenges presented by those. I am joined by a fantastic panel, which I'm going to introduce to you now. We have Mick Chadwick, Head of Securities Finance at Aviva Investors, Richard Glen, Global Head of Collateral Management Product at Clearstream, Graham Futter, Head of Repo Trading for EMEA at Standard Chartered Bank, Gareth Mitchell, co-founder of Connexion Markets, and Corentin Poilievre-Clédier, Head of Repo Clear, Collateral and Liquidity at LCHSA. Now, this is the 3rd year that I've been involved with this particular event with Global Investor Group, and it's always been a privilege and an interesting conversation to present. Normally, we would be talking about how difficult the previous year end has been, but that's not been the case this time around. So in the current benign environment without the liquidity and financing pressures we've seen before, it's interesting to take a look at and examine the reasons behind that. So to Graham, coming to you first, is QE still the biggest influence on short-term markets, or are there other factors? And is this picture likely to change anytime soon?
Morning, everyone, and thanks for having me. Yes, is the short answer, I think, to the question. I mean, QE clearly remains the driver of of short-term funding markets. In the repo space specifically, not only have we seen sort of collateral richen materially across the board, but I think what we saw last year and certainly this year as well is a compression between the different sort of asset classes as well. I think this compression is forced financing balance sheets to change structurally somewhat as counterparts hunt for yield on the bid side, and in itself that becomes self-fulfilling too from the compression perspective. So definitely compression is also a factor of what we see on this excessive QE front with the high levels of cash that we see being put to work in the front end. I think that's the main driver by far, but I think other things that are happening, which we certainly saw through the first quarter, is the will they, won't they SLR decision by the Fed. We obviously found out last Friday that they are not going to extend the exemption given to the SLR for treasuries and depots that they gave through the COVID crisis last year. It was a protracted sort of outcome in terms of waiting for the decision. I mean, it was quite a political decision in the end, I think, with some of the senators getting involved in terms of not, being against allowing it. But long story short, it's not going to extend. And if I'm honest, I think the reaction to date, at least, of the non-extension has been somewhat muted, more muted than I thought it would be. but I think some of that could have been that there was a lot of the US GSIBs were pretty heavily involved in advocacy in terms of trying to get it extended. I mean, it was pretty public. Some of the larger names certainly trying to lobby the Fed to extend. Maybe those guys, saw the writing on the wall pretty early, given they were actively involved in the lobby. And I think some of the sell-off we saw through Feb and March was driven in part, I think, by people realigning their balance sheets for the SLR. Now, what does that mean from the repo perspective? I think going forward, well, I think we will see a little bit of some further retracement, I think, in repo balance sheet as some of certainly those US houses come to terms with reorganizing for the SLR. Obviously that means that will cheapen collateral somewhat, and I'd say all this in context with keeping in mind this massive wall of liquidity we have in the front end, and it's quite difficult to score what that change in the SLR will do because of this wall of liquidity that we have, right? So difficult to score that, but certainly that is a moving piece in the market that'll be interesting to watch through the next quarter. March QE does remain relatively benign, right? Even post that decision. So if that's the benchmark as to how it will happen, I think that's probably the most we've got to go on at the minute. But clearly March QE is benign. We saw some moves in the FX implieds, off the back of that, but nothing out of the ordinary that you wouldn't expect across a quarter end. But does that manifest into slightly reduced balance sheets, slightly less dollar liquidity available across maybe the next quarter end? It'll be interesting to watch for. Just quickly as well, the other thing to keep in mind, I mean, it's very US focused, but this is where the big moving parts are at the minute is the roll down of the TGA. The Treasury General account, that's obviously, you get cash additives, really just effectively moving liabilities on the Fed's balance sheet from the Treasury to banks. That'll increase cash in the front end as well. The Fed off the back of that, have said that will have increased the limits on the reverse repo facility to try and provide a floor under the repo market in the US. So it'll also something to watch for and how that plays out over the next couple of weeks. So, just very quickly in summary, yes is the answer. QE is the main driver. Keeping excess levels of cash in the front end will keep repo rates low on an absolute level, but also on a sort of across the asset class compressed basis. And I think to see any change, we'd have to see a material pullback in QE to affect that, right? So
relatively calm waters to continue for the time being. Corentin, any thoughts on that?
Yeah, thank you, Bill. Well, a lot has been said by Graham, right? I mean, I think at that stage, the market expect the repo level to tighten as a result of QE, but also just a variety of most recent announcements from central banks. So the way we look at it as infrastructure is that, if anything, it makes it even more important to ensure when you are a market participant that you've got efficiency and you get connected to the right liquidity pools so you can basically manage your costs more closely. So it's all about really cost management. I do agree that the most recent QE announcement, they have less effect now because the market has kind of got used to it into managing this way. And you would need a long-term structural change to see that. But if anything, it's one additional layer that tells the market that they need to manage their cost and get connected to the right pools. The second aspect for us is a little bit more on the side, but we do see a difference in the type of collateral that we receive as a clearinghouse. Because obviously the kind of high quality papers that get given to us as collateral is the same type of paper that usually is reserved for QE repurchasing program. So we see usually when people expect massive QE, we're going to see more cash flowing in or the other way around. And clearly now the effect of it is quite minor, so it's fairly stable.
Okay. Turning maybe to the size of the market, we have the latest ICMA survey, which has just been released, which shows an overall market size of around just a whisker under 8.3 trillion, which is up 5.1% from June. These figures are for December 2020, so up 5% from June 2020, and just a little bit lower than the record high of December 19, which is 8.31 trillion, down 0.3% year on year. So the survey covers 60 participants, and I wondered, Gareth, I mean, one of the things which is a struggle sometimes when we look at size in the repo market is avoiding double counting and capturing all the activity in various locations and different types of activity. I believe you've done some work on trying to put a figure on that as well. So what are your thoughts there?
Yeah, thank you. First of all, I think I should praise Richard Comotto's job of trying to put together these numbers. As I found when we were doing a lot of this research, it's very, very difficult to get there is no finite source for this information. I think the ICMA survey does a very good job of showing the trends, and therefore you can see, is the market getting bigger, is the market getting smaller, looking at the changes in the collateral makeups. I think that given the size of the participants in that survey, I think you're getting a good feel from that of what is actually what the market is doing. I think within this particular survey, he's also now attempted, and I think the word is attempted because I think that's an even harder role, to actually try and combine that with what we're now getting from some of the SFTR numbers, which are again challenged at certain times. So I think but what we can see, and I think relevant to the panel, I mean, there's a lot of information in that survey, and and what we've been going, is that the overall market size, is what he's saying, roughly 8 trillion or whatever, which is not far off what we were sort of seeing in terms of the European participants. I think here. I think you add there that the US, again, the numbers there are even probably harder to track, but we're seeing probably 5 to 7 trillion there. So what we're seeing, a $13–15 trillion overall market. Yes, there is an element of double counting in those numbers, but what I think we were focused on is how much of that overall market is sort of not it's sort of buy side, not just bank to bank flow, and again, I think it shows up a bit within this survey, and that that it's certainly over 50% and probably nearer 60% of the market is sort of buy side to sell side, client funds or whatever to banks. So we're still looking at overall somewhere anywhere from sort of 6–7 trillion to potentially 10 trillion of buy side business that is flowing into the banks. And I think when we we try to break that down, obviously the buy side is made up of a lot of different types of sort of companies, obviously the asset managers, with a lot of the business probably at the larger end of the asset managers, those have got the large capacity to sort of do this sort of business. But obviously sovereign wealth funds, CCPs, goes on and on and on. And the reasoning behind why they're doing this business varies completely for what type of structure they are. But it was quite an interesting process of trying to break these numbers down, look at where that business is, look at the currencies in that business, and again obviously dollar and euro roughly the sort of same, around the 5 trillion-ish, 5 to 6 trillion each, and the rest made up of sterling and other currencies.
Okay, thanks, Gareth. So it's a good snapshot there, and I think addressing some of the, I suppose the thing that's surprising is perhaps the percentage that's made up by the buy side. We talk about it sometimes almost if it's a smaller part of the market. It's definitely significant, but also what's forgotten, and you make the point very well, is the buy side is a very a varied thing. They're made up of a huge number of very different types of participants. So from that's our best estimates at the overall size of the market. Corentin, from a cleared perspective, what percentage currently is made up by cleared, and how much of that is made up of buy-side clearing.
Yes, no, thank you, Bill, because I would echo your initial comments, which is that, we've all have got to thank, ICMA reports for trying to put some numbers around the market we evolve in, because it's not always easy to find just the right sense of scale. And I've got to say, it's confirmed the things that we were collating when we spoke with, with members, trading venues and so on, but it's always good to have a sort of a single source of truth. So indeed, what is estimated to be the case, and you now have the very useful SFTR reporting to kind of cross-check that, is in the growing market we talked about. So you talked about plus 5% between June and December last year. That's the trend indeed. Then we get a sense that about 51% of this is cleared. And this is a share that tends to be growing a little bit faster than the market itself. So that's what we've seen for the last a little bit more than 5 years in the cleared space. Where you are completely right is in this cleared space, it's practically entirely what we would refer to as dealer to dealer. So sell side to sell side. There's just much more, used to clearing. It's just something that has been in their DNA for a very long time. And the way we work is just very fit for banks. It's just a longer, much longer history that we have with the sell side up to now. If you take this 51%, and I'm just gonna lean on the latest FinHub article to talk about what we represent there, because you're always sort of conflicted otherwise, right? I mean, I think LCH is around 80 to 90% of this 50%. So that's the view from which we look at the world. So now it means that you have 49 to 50% of the repo market that is not cleared. And there we know that the vast majority of it, not all of it, but the vast majority is dealer to client. And that's where indeed you find your buy side being, as Garrett said, quite rightfully, lots of different families, different types of funds, different types of insurers. So to break sort of the suspense straight away, I mean, not everything is fit for clearing, clearly. I mean, we would never tell you that, right? But there is probably still in this segment of the market some element of virtuous circle that can be built by marrying the right buy-side firms through the right model with the help of sell-side with CCPs. And I'm sure we'll touch on that later, but that's in the clearing space, that's what has been usually referred to as sponsored model, hybrid model, these kind of things. And it's quite important to flag that it took a little bit of time to get the model right, because you've got to find a way to allow those buy-side firms to appropriately participate in the clearinghouse with the combination of individualized risk and neutralized risk. Because they can have legal impediment, they can have operational impediment, they can have risk appetite that doesn't allow them to participate in a classic manner, if you want. And it's also critical that those models are built in a way that is also freeing some capacity for the sell side that help those buy side join the clearinghouse. Otherwise, you're just adding burden to the balance sheet that's already quite constrained. So I'm sure we'll touch on that, but bottom line is half of the market still uncleared, probably a certain percentage of it would benefit from clearing, but we have to get the model right and we have to continue that dialogue so clearing becomes just much easier, right, to understand and access.
Yes, Dorothy. So we've established as best we can the size, roughly the amount of the market that's cleared. Turning to Mick, maybe first in terms of an actual buy-side participant. We should probably hear from you in terms of the routes to market that you're utilising in the buy side typically, and maybe the factors that determine that choice from your perspective.
Yeah, absolutely. Thanks, Bill. I mean, as previous panelists have said, the buy side is not a kind of homogeneous population. There's a range of different types of institution. And the routes to market they look at, and how urgently they prioritize those, are going to vary from firm to firm. To the point made about the survey, I mean, there are some large institutions such as ourselves who are continuously active in the market every day, and we're actively engaged in discussions about new routes to market. But it's probably also worth mentioning, there's a very large tail. There's a number of small and mid-sized players for whom repo isn't their day job. Their involvement is smaller and more intermittent, and they're not necessarily incentivized to, they're fine with the current OTC kind of interbank model. and even for us, and then Quarantine picked on it already. I mean, yes, we have an obligation to explore and keep an eye on new routes to market. But even for larger firms, whether it's peer-to-peer or central clearing, these are only ever going to be partial solutions. I mean, I think the current OTC interbank model will remain, the nucleus of our repo funding for the foreseeable future. Now, what Graham was saying earlier about the current benign market environment, in many ways, that's been the case, and you can argue that takes some of the commercial urgency out of these conversations. But particularly in the UK, this week, we're marking 1 year since we went into lockdown. It's also worth remembering that this time last year, market and liquidity conditions were somewhat less benign, which is a kind of reminder that liquidity stresses and liquidity events can kind of blow up very quickly and become very acute. So there isn't, for anybody that's continuously active in the market, you do have an ongoing obligation to ensure that you continue to stay across all these various routes to market. In terms of prioritization, it really depends how large and also how diverse you are as well. I mean, some institutions may be very big, but they've only got one type of trade to do. They're always the same way around. They're always coming at the market from the same direction. Within our world, we've got a more diversified book of business. We've got on one side of the balance sheet, we've got, our LDI franchise. On the other side of the balance sheet, we've got, an award-winning range of AAA rated liquidity funds that use reverse repo as a liquidity management tool. And then you've got the kind of general insurance and life business that can be at one side or the other. So, there is scope for us to explore the viability of internalizing some of that deal flow and trying to work out whether or not we can generate some efficiencies within our own universe, as well as continuing to monitor and maintain access to external liquidity as well.
Thanks, Mick. So, other award-winning liquidity products are available. We can't let that shameless plug go unnoticed. Richard, turning to you. So it seems, and it's logical when we look at the diversity of the buy side, and as you say, putting together a catch-all term for some very, very different organisations is difficult. But we'll do our best as we come through this panel to cover that off. So it's finding the right tool at the right time, and that may vary depending upon obviously the size of the organisation and the frequency and necessity of participation in the repo market. Is that something that you see at Clearstream, and I guess what are the more common routes? What are the considerations? What are the conversations like that you're having with your clients?
Thanks, Bill. Yeah, I mean, I guess for us as infrastructure, exposure to the buy side and interaction with the buy side wasn't something we really did until the start of the financial crisis. And it was at that point when certainly banks became under a lot more pressure. And specifically then many buy-side firms found that there was a greater push into secured liquidity solutions rather than unsecured liquidity solutions. That many of those buy-side firms, and the panelists already mentioned, buy-side is a very generic phrase that can capture a number of different institutions. But I guess for us, the initial routes to market that many of those firms saw were talking to their existing house banks and finding out how they could, access that secured market more easily. Now, for us, from a tri-party perspective, obviously tri-party collateral management offers operational scale and efficiencies, and many sell-side firms already use this to a large extent. But if you're a buy-side, and particularly then in our case a corporate treasurer, and looking to access that market, you want something that's relatively simple off the shelf where you can place your money. But apart from seeing a collateral statement, you don't really want to be able to do anything else. So tri-party at that point in time seemed like a ready-made solution to a number of the problems. Now, that being said, as many banks and their clients will also know, onboarding with a new institution isn't necessarily the easiest. It's certainly become a little bit easier, dare I say, in COVID worlds, because processes have become more digitized. But the fact that you need to go through that ongoing due diligence process and sign up with a number of different counterparties and banks, obviously, bifurcates a number of different flows across the board. But as a result of that, we then saw the emergence of peer-to-peer trading solutions, and therefore looking to encourage a marketplace to be created for this demand. But then separately and over and above that, obviously then at that point in time, there was also the door opened to clearing. And so whilst I think uncleared solutions certainly work for a number of clients, particularly those that are looking at yield enhancement, for those that are looking at more security, the clearing models that are offered by the likes of LCH and also Eurex certainly seem to be growing in favour. It's just a question now in terms of the model as to whether a direct model or a sponsorship model makes more sense, and looking at the costs and the risks associated with those different access points, which one would then be more favourable to each of those different segments. You're on mute, Bill.
There's always one, isn't there? It shouldn't be the moderator, though, to be fair. Just probably a good point to mention to the audience: if you do have any questions, you can submit them. And one that we've had come in, looking at, I guess this is relating to the uncleared portion. So any idea how much of the 49%, so that which isn't cleared, I'm guessing is what the question is asking, how much of that 49% is supplied via agent lenders? Graham.
Well, I mean, I think, I'm probably less of a student than the likes of Gareth on the likes of the ICMA report and stuff. I mean, I have read it, but I think, I can speak, it's maybe specifically for our own experience, and there's no reason, it might be anecdotal, but there's no reason to believe the sort of the makeup of our book is materially different to similar players, I think, is a fair statement. And our sort of experience will pretty much concur with what we saw in the ICMA report with respect to the buy side. On the asset side of the balance sheet, of a little over half would be in that sort of space. And then specifically to the lenders, we would have anything between 25 to 30 as well of that space in lenders. So in terms of specific of the 49 that came out of our report, I'm not too sure what the balance would be lenders of that. But as a rule of thumb, I think you could say, it would be 1/3, 2/3 kind of split. I think would be a fair assumption. I mean, I think the other thing I would note as well, with regards to makeup, in terms of the buy side, I mean, we clearly see, a bias towards higher quality collateral when we face off with buy side guys, which I don't think is going to come as a surprise to anybody, given the types of collateral that certainly the more traditional asset managers and insurance houses will traffic in largely, and obviously those balances are large. So we definitely see two splits, right? One is on the asset side we see obviously more activity, obviously, but we also see that skewed in a high quality collateral. This is what we may see away from banks and others.
Thanks, Graham. I think one of the questions that's interesting is when we touched on it in terms of the, as I describe it at the top, the benign conditions we find right now. We didn't see a big year-end liquidity spike. There seems to be a lot of liquidity available, and we'll talk more about the sort of various routes to market a little later in the piece. But do you think that, and I think Mick, you probably touched on this, do the benign conditions act as a tool that stops people exploring some of the solutions, perhaps? Because if it ain't broke, don't try and fix it, and perhaps getting engaged in that forward thinking, perhaps solutioning for your routes to market is less important when it seems that there's not a problem right now.
Yeah, well, like I said, I mean, I think the current environment has dialed down some of the commercial urgency of these debates, and also the large buy side firms for whom this is relevant. Typically you're talking about large institutions that have got competing demands on their resources. If you only have to look at the kind of the regulatory alphabet soup that we're still digesting. Last year was SFTR, this year's UMR, next year's CSDR. Now, it's absolutely the case you know, I think it was George Osborne that said, you know, you ought to fix the roof while the sun is shining. You know, you ought to be making sure that as far as is possible, you can kind of future-proof your franchise and optimize your business model, you know, whilst you're able to take advantage of this benign environment. Because if you wait until you're actually in, you know, the eye of the storm before you start putting these steps in place, then, you know, you've lost already. So there's definitely some validity to the idea that, you know, you can't be complacent and you need to, you know, be a little bit forward thinking. Having said that, you know, to torture the weather metaphor a bit further, it's all very well saying you've got to fix the roof while the sun is shining, but there needs to be at least a cloud on the horizon for you to be able to marshal the resources within your firm. You know, you look at an initiative like central clearing. You know, we've been through that for OTC derivatives. We know it's a pretty heavy lift. You know, and therefore there's got to be a fairly compelling business case that you can make in order to justify marshalling the resources. You know, whether that's IT or project or, you know, business people, getting that to the front of the priority queue without there being an existential threat to your franchise can be a little bit of a challenge.
Yeah, I think that's a good point. I mean, it's certainly not unusual from my experience working with clients that whilst there is a sense that now is the right time to work on something to get your house in order, there's always another thing. And some of those projects don't seem to, for want of a better term, sometimes don't seem that sexy compared to other things that you could be putting your cash and resources towards. So I think that can be a challenge. And one of the things we spoke about when we were preparing for this panel was the life cycle, if you like, sort of the soup to nuts process of a securities financing transaction, repo or securities only, but repo in this case, and that it is to a certain extent rather clunky, shall we say. There are various moving parts that don't necessarily always join up that well, from execution through settlement operations, collateral management, etc., and also regulatory compliance. So now would seem to be the right time, to your point, Mick, to put some of these things in order to ease the burden. But what steps do you think we should be taking? So Gareth, maybe if we come to you from a trading venue perspective, if you like. Another note from the ICMA survey, I think automated trading systems accounted for just over 1 trillion of that business we spoke about earlier on, 1 trillion euros. So I think that was down from 30%. And they attributed part of that fall to being, or part of the spike before that, the increase prior to that, to home working, etc., and the coronavirus crisis. So electronification became more important. But from a trading venue perspective, what more could be doing, and maybe touch also on what the benefits would be.
Yeah, thanks, Will. I think, again, as part of when we were sort of setting our company up, and going around and talking to a lot of the buy side, we were really trying to focus in on, what their issues were and why have we got still a market where 50+% is still not electronified really to a large extent. And you think nowadays, you want to get a taxi, you just push a button on your phone and the taxi just turns up outside your door. Majority of people that are doing repo on the buy side are doing it the same way they did it 15-20 years ago. It's a Bloomberg message, it's a phone call, and then both sides are tapping away into their own systems a trade ticket. So I think some of the focus that we look at is it was looking more on the pre-trade, getting the pre-trade set up so that you wouldn't have to sort of go through who you can trade with, who you're allowed to trade with, the legal structure, how, putting that all in place, making that legal structure more simplified. I think there's something right at the very end of that ICMA survey saying there's 23,000 odd GMRAs sitting out there at the moment. you try, you look at some of the asset managers, they represent multiple LEIs, in some cases hundreds of LEIs. How do you find a better way of controlling that? Which LEI can trade with which LEI, and which So I think a lot of the focus that we were going was trying to make that legal structure more simplified, make the make the controls of who you can trade with and how and what you can do with them more simplified, so that when you get to the trade side, that bit it's all there. It will only let you trade with who you're allowed to trade with. It will only in whatever instrument or whatever that you're allowed to do. I think standardization doesn't really exist out there, and when it gets to collateral, it does not exist. So the types of trade, how people book their trades on one side to how people book trades the other side, we found that there's quite a lot of difficulties. Some people can roll interest in trades, some people have to close and reopen trades. So I think that there's still work to be done there for the markets to perhaps be a little bit more accepting of that. To make this market more automated, there has to be some element of standardization. But when it came to looking at the collateral side, and I think tri-party or whatever is probably the way a lot of people should try and aim to go. Tri-party itself then throws up an awful lot of other issues, particularly for the collateral giver, of where is their collateral currently. That collateral tends to be sitting in omnibus collateral accounts at some custodian. How do you control a automated tri-party that's extracting collateral from an omnibus account? It just doesn't work. So it's all these issues that that's still to be resolved. But I think that's I think we've attempted to go a route of of solving for some of these things, and we'll continue on to try and solve for others as we move along.
Thanks, Gareth. I think that's a good description overall, and some of the challenges you highlight there. Emphasize the point I made at the top, which is you could call it clunky. Mick, from a trading venue perspective, what are your thoughts?
Well, I mean, I think there is a secular trend across all markets towards greater automation and greater use of electronic trading platforms, and one of the big drivers of that is, well, I mean, pre-trade, whether you're in scope for MiFID or not, the requirement to demonstrate best execution, to have an audit trail, to show, to any stakeholder that, you're getting a competitive fill, if you like. But also post-trade, the automation of post-trade processes, settlement, SFTR reporting, all that kind of stuff. And there's no doubt that using a kind of screen-based solution does create operational efficiencies for the fund manager. Bear in mind that a fund manager will be acting as agent on behalf of the underlying client. There are definitely some operational efficiency gains there. The magnitude of those is going to vary by firm. If you're only doing half a dozen trades a day, debatable whether you need to electronify that. If you're doing north of 100, then obviously it becomes a more attractive proposition. But the point to make, though, even if you're using a screen may make life easier for the fund manager, it doesn't necessarily translate into best execution as far as their underlying client is concerned. Because let's say, unless a trading platform has a kind of ubiquity across the market, let's say for the sake of argument, you've got 10 repo counterparty banks that you normally trade with. Unless all 10 are signed up to a particular platform, if you're using a platform and there's only, say, 7 or 8 banks on it, then that's only a partial solution. So you can't, in all honesty, look your underlying client in the eye and guarantee that you've got best execution kind of trade by trade. The other thing to mention is most of the electronic trading platforms out there, I would say they shouldn't be categorized as representing a new route to market. You know, they are simply an electronification of the existing business flow. And I think, you know, Gareth's probably being a little bit bashful about his own product, in the sense that what he's trying to do at Connection is something a little bit more ambitious, which is kind of create an ecosystem that does facilitate, you know, a change to the business model. But I mean, in terms of going back to the kind of various screen-based models that are out there, we will speak to a bunch of banks and say, you know, we're interested, you know, will this make our execution and the service you provide to us slicker and better if we use this platform? And they're all far too polite to be rude to us. They'll be saying, well, it's up to you, you know, we can accommodate you whatever angle, whatever avenue you guys want to choose. So we're basically waiting for the sell side to tell us their preferred, you know, execution avenue. The sell side will have similar conversations with us and say, well, we can be flexible, which do you want to use? So it's almost like after you, Claude. You know, the buy side and the sell side is kind of waiting for each other to give them a steer in terms of, you know, how and which execution platform they want to use.
Yeah, it's interesting, Mick. Graham, your thoughts on trading venues? I mean, pros and cons.
Yeah, look, I mean, you know, I would say there's 3 points I'd make on this. I think Mick has stolen my thunder a bit on the first one already. I mean, it's, you know, from our perspective, you know, I think what Mick was saying in his previous conversation around, you know, trying to fix the roof while the sun is shining, trying to get resources to implement some of these changes is difficult. You know, given all the other things that are going on in the world. I think from our perspective, it's probably a little bit easier to get the resources. I think for a couple of reasons. One is sort of what Mick has just said is, you know, we really are looking to facilitate on the client side, right? And if we don't implement these types of changes, you know, it's almost like a minimum threshold to compete in the first place. Yeah. So, you know, I think getting the motivation internally to implement some of these things is easier from our perspective. Plus, I think the benefit of scale is also on our side, mostly across implementing some of these different channels. So those would be the first thing. And I would also say, to what Mick said earlier, you know, we see very little sort of hard requests to change the way we interface with the buy side. I think that's a fair comment, right? You know, certainly over the last couple of years, that we're not getting any sort of hard requests to do some step changes that we see, and you know, that's true for the wide range of buy side participants that we face off with. I think the second point, with Gareth also touched on, and I think it's probably the most difficult one, is around standardization. You know, for this market to become less clunky, you know, standardization is probably a requirement to automate as much as you can. I mean, that's true for all markets. But I think the problem we have, well, the thing we're going to have to try and solve for is that, you know, since the GFC, right, the value of collateral has become inherently much more valuable to an organization, right? Yeah, for a number of reasons. You know, solving for liquidity, solving for margins, solving for regulatory costs. You know, the value of the collateral is really much more important and much more valuable to the organization as a whole. And I think the point being is all organizations have a range of constraints, and those constraints are not uniform across organizations, and they also change through time. So, you know, that doesn't lend itself well to a standardization, right? So you've got this sort of trade-off between, you know, do you go for a standardization kind of simplicity model where you have defined collateral sets, defined tenors, defined haircuts, venues, etc., versus maybe losing some of the unique or sort of specific collateral utility that an individual organization has in fostering bespoke kind of solutions, right? And it's that trade-off, I think, that's going to be interesting to watch over the next couple of years. I mean, I think we definitely sitting more in the latter part of that equation, given the lack of sort of standardization. I think the bespoke nature that we transact in. I think the last one quickly, which is really an organizational historic factors, is really the lack of centralization across an enterprise sort of view of collateral management. And this is, if you've been to any collateral congresses or conferences in the last 10 years, this is the favorite of everybody's. But the point being, it's on the agenda every year. I think it means there's still a lot of wood to chop in the space, and this is certainly true for the sell side at least. And you know, even when we face off with the sell side, we are still facing off with variable desks within the same organization that seemingly don't speak to each other. And I think, you know, the real sort of utility of that value is lost as a result of that. So I think in summary, very quickly, is, you know, I think we do see some standardization. I mean, even if you look forward to the Basel IV regulations coming in 23, you know, they're talking about standardized haircuts and the like. So there is there might be some sort of regulatory driven kind of standardization. I think we see a little bit more of a march to cleared. I think that rate will change. I think a lot of the low hanging fruit is gone in that space. You know, and maybe through time, I think the buy side gets more comfortable with things like tri-party, et cetera, et cetera. I mean, it's certainly, with regards to margin and the general financing our book has made the scale and the efficiencies are big cost savers for us in managing you know, liquidity and collateral value, right?
Thanks, Graham. Richard, turning to you. So clearly a need for standardization, automation. Do you think there's one particular event on the horizon, or what's going to be the catalyst? There seems to be lots of work to be done, and lots of work that we all recognise needs to be done, some of which will fall by the wayside from a value perspective, if you like, in terms of the actual cost to get them, and whether it's appropriate for the various size of organisation. But do you think there's one catalyst that's going to move, if not all, the bulk of the market in that direction?
I think, to be honest, there's a couple of things. I mean, obviously, regulation plays quite a substantial role in harmonising and standardising the framework. Certainly, if I look across CSDs, tri-party agents, and that financial market infrastructure layer, there's a number of rules, particularly in the Eurosystem, that are coming in over the next few years, which are going to increase harmonisation efforts. If I'm being, you know, frank and transparent and honest about, you know, the business, COVID has been a game changer for the industry, and I mean that insofar as, you know, there are a number of processes which historically have been largely paper-based, whether it be KYC and onboarding, whether it be asset servicing, tax certification, et cetera, where clients and custodians are now looking at different digital technologies as a way of making that process more efficient. And, you know, to coin the phrase at the beginning of this session, that, you know, post-trade has never been sexy, because it's always been largely Excel-based. But now when you start looking at new technologies and you look at dashboarding opportunities and you look at automation, actually there could be a little bit of a twinkle in some of these processes which were previously considered a problem. And the primary reason why that is because a lot of the post-trade, particularly collateral management activities, are now largely more focused on the front office. So, you know, I think it's encouraging that COVID, ironically, has created an opportunity for us to change that. And if the investment comes into the business, if we can automate, and to Graham's point, if we can match that you know, combination of standardization plus a few little bespoke features which are a real game changer and a USP for clients, then yeah, the world's going to be a safer place, but the world's going to be a sexier place.
Nicely put. Thanks, Richard. I've got a few questions that have come in, and I'm going to look at a couple maybe together now and just catch up, or maybe put together a couple of points that have been made. And Graham mentioned the fact that you will see potential, he sees a move towards more cleared going forward. So Corentin, one of the questions I think maybe looked at how you address the heavy lifting, not my term, in terms of moving towards CCP, and also coming back on the point around the need or desire for standardization. Does clearing provide that level of standardization, or move it at least in that direction?
Yeah, thank you, Bill, for both of the questions. So yes, of course, clearing does provide the level of standardization. That's what clearing does, right? It's sort of a one-stop shop, hard to enter into with all the clearing rule book that you have to get your legal department happy with. And I mean, Mick touched on that quite rightfully. I mean, joining a CCP is not something super easy. But what's quite important to remember there is this is something you do once, whichever level of business you're going to do with the CCP afterwards. So once you're in, basically. But to your point about addressing the heavy lift, allow me to be quite basic here. I think it's for us to have to provide and to demonstrate the compelling business case. We've heard today with the Panelists, right, that there is an element of anticipation, because right now there is an artificial kind of easiness on the market because of, you know, intervention from the authorities. So they need to anticipate. Buyside have competing resources within their firms, and they're so diverse. So when you take all of these constraints into account, then from my perspective, it's a matter of offering a choice that is the right one. And by that I mean we've got to offer scale and choice, so that basically when an institution engages into joining a clearinghouse with all the difficulties and the time and so on that it means, and we're here to accompany, but the difficulty is real, then they find what they were looking for once they join. they find the right scale of liquidity, and it's a liquidity that has to be there all the time, BAU financing, but also crisis. So what COVID has given us, I think, is just a good chance of demonstrating yet another real track record of being a safe harbor that's super, super stable at any point in time. Because when you have competing resources, indeed, you've got to make your case internally. We understand that completely. So we've got to be, as CCP, in a position to give buy-side firms the right elements that they need to make their case. So the case is, you've got liquidity when the sun shines, you've got liquidity when it rains, and it's the same. It's difficult to get in, but once you're in, you do as much as you want. You're in, basically. And once you're in, you also need to make sure that if you are a pension fund or an insurance or an MMF, well, effectively you have, in our case, for example, 14 government debts and GCs and different collateral. And to finish, what we try to continue to build our offering upon is choice. So now saying it's, we would love to link it with open access, but what it is client choice. So what we want to give you is options, basically, and then as a buy side, you can pick and choose your agent, your trading venue, your custodian, your settlements, because then it becomes tailor-made and it's worth the effort. So I would conclude in saying, yes, it's quite heavy to join a clearinghouse. I'm not going to say the contrary, but what we need to make sure of is that we are definitely worth the effort, because once you're in, you will find everything that you need in the long term.
Okay. So I guess to summarize that, whilst and again, I'm using the term heavy lifting advisedly. There's some process to go through to get there, but once you're there, that pain is paid off by the benefits, if you like, that you get once you're in place. Mick, from your perspective, any thoughts on that statement? That yes, okay, that there is some pain there, but it's worth it in the long run.
Yeah, I mean, I think everybody understands the overwhelming business benefit from netting for the sell side is the balance sheet netting. That was, you go back to the 1990s. I mean, that was the whole, impetus for central clearing repo in the first place. Now, from a buy side perspective, like I said, we've got entities within our sphere on either side of the balance sheet, but at the individual legal entity level, very seldom are they on both sides of the balance sheet at the same time. The overwhelming majority of buy side firms are one way round or another, meaning that the netting potential is somewhat limited. So in order to help us make a business case for central clearing internally, we would anticipate that the majority of the commercial benefits from central clearing actually accrue to our sell side counterparty. So the question then becomes, to Graham and his peers, if we were to trade via a CCP, what is the commercial benefit, either in terms of basis points per annum or additional balance sheet capacity or whatever? Can you pass, assuming that clearing centrally is of benefit to our bank counterparty, how much of that benefit can be passed on to us to incentivize us to embrace that model?
A good point, Mick. I think I did a panel recently looking more at the securities lending side of the securities finance market, and one of the comments which came out, which is not unusual, was around the expansion of collateral parameters, etc., by lenders, and the response, as you would expect, would be, okay, that's good, we can look at that, but what's the benefit for me? If I look at pledged collateral, then there's a benefit for my borrower. Do I get an additional fee? What's the upside for that? So to Graham, to Mick's point there, if I join CCP and you pick up all the benefit, what's in it for me? You're on mute at the moment, sorry. Graham, you're on mute.
It had to happen at some point, sorry. Look, I think it really comes down to this, right? I mean, clearly the banks are, as everybody said previously, right, are much more afraid with this, are super active with each other in this space, and it really comes down to and I do think, like I said earlier, there will be a slight increase in the trajectory into cleared. I think it'll be at a slower pace than we've seen since over the last decade, certainly. as most of the low sort of hanging fruit has been done. But I think the point being is what Mick was saying. The bottom line is netting, right? It's a bit of a chicken and egg kind of story. If netting opportunities are available in a cleared environment, the banks will come. I think is probably the mantra that you want to think about. There's clear advantages for the bank there, and in terms of being able to pass on pricing benefits, it is definitely a less of a burden on bank resources to trade within a CCP. There's less potential capital charges, etc., etc. So, it really is a netting thing, though, right? I think the point being of where banks have been so overly constrained from a balance sheet perspective, like we saw post GFC, where the SLR was a huge constraint, certainly for a lot of the US banks, is probably not in the same situation as it was back then. So balance sheet is probably less dear. But we should always be trying to do things in a smarter way and using less resources to do so, right? At which point, as what follows is liquidity, what follows is price, right?
Thanks, Graham. I'm conscious of time. We've got about 5 minutes left on our planned running time. So we're going to put a couple of questions from the audience to you, and please wave a hand if you want to answer. How much of a disruptor to traditional models is peer-to-peer lending within the buy side? So how much of a growth opportunity is there, and what could it mean to rates? Anybody want to take that one? Mick.
I mean, slightly mealy-mouthed answer, it depends. Because like I said, I mean, within our universe, we've got plenty of scope to explore peer-to-peer financing, without even looking beyond the world of Aviva. Because as I said at the top, though, peer-to-peer is only ever going to be a partial solution. The nucleus of our financing is going to carry on being with banks. And if you're talking about, obviously, central clearing, what you're doing is you're replacing one form of intermediation with another. Instead of being intermediated by the bank, you're being intermediated by the CCP. A genuine kind of peer-to-peer model without a central counterparty, you've got to look at what services the bank provides and how you replace that if the bank's not there. So credit intermediation, that's massive, right? A lot of long only asset management companies and other buy side firms, these are quite policy driven organizations. So they'll have some kind of rules based methodology for figuring out who you can trade with. The overwhelming majority of buy side entities themselves aren't explicitly rated. So how do you solve for that? The other one is, maturity transformation. Generally speaking, most providers of liquidity need to keep it at the front end of the curve. Most takers of liquidity need it further out along the curve. Traditionally, the bank steps in the middle and manages that maturity gap. Again, genuine peer-to-peer has to, you have to find a solution for that. The point Gareth touched on already about the legal environment and the difficulty having, hundreds and thousands of, individually bilateral, GMRAs, that's not really viable. I don't think peer-to-peer will necessarily have an impact on rates, because almost by definition, you're taking one side and, both sides of the equation out simultaneously. So I don't think peer-to-peer growth will have an impact on rates. It'll have an impact on volumes. But like I said, I suspect it will be a fairly niche pursuit for most people. The good news is, it's a $10 trillion market. So even if it's only a niche, it's still a meaningful book of business potentially.
Thanks, Mick. We've just got a couple of minutes left, literally. So I think from a questions perspective, we're almost there. One quickly for you, Gareth, if you can be as brief. Mick mentioned previously Connections was a different offering to some repo platforms. Can you tell us give us your water cooler pitch? You've got 20 seconds.
The elevator pitch. I think, first of all, we are not a disruptor. We are an enabler. So what we're trying to do is to make existing practices more efficient and allow people to do things they can't do today without us. And I think so. Yeah, and I think Mick has sort of touched on the credit side. We have a solution on the credit side. Yeah, the legal side, we have the solution on the legal side. Yeah, so we've gone from that way rather than just saying, well, here's a market, let's electronify. So I think that's where currently people are trying. We've got peer-to-peer transactions on the platform. If someone comes to us and says they want to use a cleared solution, we can feed that cleared solution. We're not stuck on one solution. We tried within the platform to bring in some form of standardization, but at the same time give quite a lot of flexibility, if that's not an oxymoron.
That's quite an elevator ride. Thank you for that, Gareth.
Okay.
And we're going to sadly have to close there. So I think a brief summary. And again, it's very difficult when we talk about the diversity of the buy side to find solutions for everything. Clearly, there's a lot of work to do. It would be great if we were all able to take the opportunity to get our houses in order at this point in time, but that's not always the way that organisations work, unfortunately. Clearly, there are a lot of benefits for clearing if you jump the initial hurdle. And I think one thing we didn't manage to touch on, unfortunately, because with time has beaten us, was some of the operational perhaps benefits and settlement benefits that are there as well. But listen, it's been a fascinating panel to moderate. So thank you all to my guests. I hope it's been something that the audience have enjoyed. And I'll hand back to Aninda. Thanks very much.
Thanks, Bill. That was a very useful and informative session. And thanks again to all of our speakers for sharing your views. I think we covered quite a number of subjects there, sort of clearing, liquidity, tri-party, standardization, automation, and a lot more. So we hope that this session has provided you with some nuggets to get your house in order. And I liked Mick's weather analogy, and to quote that, it now might be a really good time to fix your roof when the sun is shining. So thanks to our delegates for sending in your questions and interacting with the panel. That really does help get everything sort of engaged, and hearing from you and your views is really important. We're now going to take a very short break, and we will reconvene at 11 o'clock, whereby we'll be joined by a regulatory panel, which will be addressing political upheaval and the impact on data aggregation, accuracy and reporting. And that's going to be followed by a fireside chat with Kaizen's Jonathan Lee, who's going to be sharing his insights on how the introduction of SFTR has gone for the buy side. So we'll see you again very shortly. Thanks, everybody.